What can butter reveal about your trading strategy?
It was found that for more than a decade, you could predict the S&P 500 by looking at the production of butter in Bangladesh. The correlation had an amazing 75% accuracy. If you included American cheese production and American and Bangladeshi sheep populations, the accuracy would increase to 99%. So what was going on, and how can this help your trading? Well, if you've started scouring the internet for Bangladeshi butter, hold your horses. This finding was made by David Lineweaver, a former quant who managed over $6 billion. He mined a wide range of international data series to find the perfect match. He didn't do this because he thought it would be useful. Instead, he wanted to show how data mining and overfitting could provide meaningless market predictions. He used this ridiculous example to highlight a mistake people make all the time. They don't distinguish between correlation and causation. In other words, they find a correlation between two different things and assume one of them caused the other, when in fact there may be no connection at all. And you see this all the time with traders. They'll spot some connection between a pattern and a market event and assume that one led to the other. Then they'll trade that pattern each time it emerges, convinced it's a sign of impending profits. To avoid making this mistake with your own trading, keep in mind the three conditions experts who study causation agree need to be in place to prove that X has in fact caused Y. Firstly, X has to happen before Y happens. Secondly, there needs to be a functional relationship between X and Y. Just like how we approach everything here at Duomo, you need to understand the logic between the things you're looking at. And finally, for X to cause Y, there can't be another factor that causes both of them, Z. This final point is the key one for traders because there'll usually be some underlying market dynamic that you're unaware of that has caused these different factors that you're observing. So rather than X being the cause of the market move, it's simply a remnant, along with Y, of something else that's already taken place.
So next time you think you found a magical signal in the market, remember to ask yourself,